Hello, everyone. This week we're going to talk about topic 4, which is risk, portfolio theory, and the cost of capital. Basically, the idea is that we have talked about how to value stocks. We have also talked about how to value bonds. But in these problems, for example, when we try to value a stock, value a company, we need to use cost of equity, right? Then how do we get this cost of equity? That is the thing we need to address in topic 4. And that also comes back to in the very first beginning when we talk about how to value a project using the NPV method, right? When we use NPV method to value a project, we also need to use opportunity cost of capital. But how do we estimate that also opportunity cost of capital, right? It doesn't like fall from sky. There needs an estimation of the opportunity cost capital. And this opportunity cost of capital is a very important measure because when we measure value of the stock, when we value projects, this particular opportunity cost of capital, it is the discount factor. And it is a discount factor, so it's gonna affect all the valuation we're gonna get. Also, it's a measure of a firm's financial well-being. It's not a so it measures the cost of the company in raising the capital, basically. And in this topic, we're gonna see how to calculate this cost of capital. Basically, there are two components of cost of capital. One is from equity holder, the other is from debt holder. Because in general, if you wanna raise financing, there are just two ways, right? One is from the debt holder, meaning like banks, right, like creditors. The second way is through equity holder. That is, you issue shares, right? And then you raise financing from equity holder, from investors in the public market. So these are the two main types. So, and then cost of capital is a mixture of these two. And this topic, I'll talk about how to get it. That's why, if you look at a book, this topic actually covers 3 chapters. That is chapter 7, 8, 9. Right? So that is 3 chapters. Well, that will be covering this topic. And we're going to talk about 3 topics. One is risk return, CAPM, and portfolio theory. So the CAPM model is the key to derive the cost of equity capital, right? And then finally, we're going to see how to use the cost of capital to value a project, to calculate. How do we calculate the cost of capital given we have the cost of equity, cost of debt, etc. So we're gonna start from talking about risk and return. The first thing we're gonna talk about is there are definitely differences in terms of different investment product or different security. So for example, the red one in this graph is bills, right? Treasury bills. We know it is almost riskless. The blue one is bonds, right? It is slightly more risky than T-bill. The third one is equity, which is a green one here. That is the most risky. And the idea you get from this graph is the high risk, high return. Right? So this shows that $1 investment in T-bill in like 1899, it's gonna grow to $2.7 in 2014. Now, which is almost like nothing if you think about all that many years. If you look at a bond, it is slightly higher. So $1 investment in bond is going to accumulate to $10.1 in 2014. If you look at equity, that's going to give you even higher return, which is going to give you 1,000. So something around $1,400 dollar return, right? So you can see, I mean, obviously it's because they have different risk, right? T-bill has the lowest risk, that's why the return is lowest. And bond is slightly riskier, so that's why you get slightly higher return. Equity is the most risky one, that's why you get the highest return, right? So basically, among these three, the T-bills give you the lowest average nominal return, which is 3.8, right? And then the real return is about 1%. So it's even lower. So, and if you look at the risk premium of the common stocks, it's going to be 7.7%. That is much, much higher, right? So risk premium of the common stock is much higher than the rest of the two because as we talked about earlier, right? So stock is very, very risky compared to bond and the treasury bills. Now, when we calculate the return, right? So there are two ways we can calculate return. We can take the arithmetic average, or we can take the compound annual return. So it's basically, so why do we need to calculate return? We need to calculate return of the past of the company because we want to know about the future, right? I mean, if you're thinking about investing in one particular stock, or if you're thinking about buying one of the stock, buying one of the bonds, then you want to know about the performance of the company, right? You want to know about how did the company behave in the past 1 year, in the past 3 years, for example. So that's why in that case you want to calculate the historical return as a measure of how the future of the company will be, right? If the company has been performing poorly in like past 3 years, then probably you don't want to buy the stock, right? Because you will think that the company is performing poorly recently, right? So it's not a good company, so that's why you don't want to invest in it. And so when we calculate historical return, there are two ways. You can take the simple arithmetic average, or you can take the compound annual return, right? So if you take the arithmetic average, that means, for example, if you have 3 years, you take 3-year average of the returns, right? So suppose that the price of big oil's common stock is 100, and suppose that there is an equal chance that at the end of the year, the stock will be worth 90, 110, or 130. So in that case, the return could be minus 10%, plus 10%, or 30%. So these are the three scenarios, right? But in reality, you can think about past returns as the realization of a company's different scenario, right? So for example, maybe if you look at the past, maybe the fact that a company's stock price appears 90, like there are 2 years, right? The chances that you have a 110, it's going to be like 3 years, right? Then the chance that you're going to have a 130 is going to be 1 year, right? So you can have, let's say, 20 years of data or 20 months of data, right? Then basically each data point, each observation of the past return, it's a realization of one possible scenario, right? You can think about it this way. So that's why when we calculate the historical average return, we're not just looking at the past. We're essentially looking at the realization of a firm's possible scenarios, right? And we assume that the possible scenarios will realize future too, right? So that's why historical return is a meaningful predictor of the future because future is going to repeat the past, right? That is the idea. So now, in each of the three scenarios, the return is going to be minus 10%, plus 10%, or 30%, right? So then expected return is going to be 10%. So in that case, the opportunity cost of capital for investment will have the same risk of big oil, right? So that is the opportunity cost capital for this particular firm. So this is, if you calculate the simple arithmetic average, this is 10% that you get, right? If you calculate the compound average, it's gonna be 8.8, right? Now you can see if you use the compound average, that's less than the opportunity cost of capital. All right. So in that case, the takeaway is that we usually focus on using the arithmetic average, right? We basically use the arithmetic average to calculate historical average, and we use that is sometimes as one way to think about future returns, or think about use that as a kind of signal for the opportunity cost of capital. So if we want to use historical returns or risk premium to estimate cost of capital, right? Like we did in this example, right? Because in this example, we use the average of -10, +10, and 30. We'll take the average and use that to estimate the opportunity cost capital. So in that case, we'll use arithmetic average instead of compound annual rates of return. Because because the compound annual rate of return is going to be lower than the opportunity cost of capital. So that is what we are talking about, right? So one way to estimate expected market return, which is the return in the future, is to use the historical average. But one of the issue here is that the risk-free rate, right? I mean the interest rate you can earn by invest in a treasury bill. Often the rate it could vary over time, right? So then that will kind of make it more complicated to calculate the expected market return using historical average. That's why here a more sensible approach is to use the current risk-free rate and add average historical risk premium, right? So you want to, because I mean the idea is that we need to use the current risk-free rate because that reflects the current market condition. Right? We don't want to use the previous one. And if we use the current risk-free return, then it's gonna better link to the future, right? Because future is close to today. And then use this current risk-free rates, we can add average historical risk premium. So what is risk premium? Risk premium basically is the risk premium is basically the return minus the risk-free rate, right? So that's why if you want to get the return, then it's gonna be the risk-free rate plus the average risk premium. So in our case, it's 2%, right? Suppose the risk-free rate is 2%, then the risk premium is 7.7%, then you get 9.7%. That is the market return. Now, so all we have been saying is that we use historical evidence to evaluate cost of capital, right? Now we use historical return basically, and many researchers, many economists, we believe that long-run historical returns are the best measure of expected risk premium, right? Because one of the obvious reasons is that it can alleviate like short-term fluctuation. It could be alleviate, for example, very short-run phenomenon, right? So, but there are other people who believe that historical average actually overestimate the expected market risk premium. So one of the reasons is that the historical averages miss the possibility that the United States could have turned out to be one of the less fortunate countries. Right? So that is one of the reasons. So one of the reasons is that the historical average might miss the possibility that United States is super lucky in terms of the stock market development, in terms of economic development, right? So why this is important? Because if you look at the future, right? If you want to look at the future, you want to capture. So if you want to look at the future and you want to make a prediction, in that case, you want to make sure that your prediction reflects all possibilities, right? So in that case, so I mean, you can calculate historical returns to infer about the future, but it could be that there are still chances that the past events do not repeat into the future, right? It could be that over the past 50 or even 100 years, United States have been really lucky in the economic development or the national development, right? Maybe in the next 50 years, it won't be that lucky, right? So so that's why the historical average might be misleading in the sense of that it could be that the country has been very lucky in the recent years, right? But it might be that in the future there could be um, there could be reasons why the nation is no longer lucky anymore. Right? So that is the reason why maybe historical average is misleading or overestimates the market risk premium. Um, the second reason is that the stock prices in the US have outpaced the growth in company dividends or earnings in many years, right? So why is that a concern? Because we usually think that the stock prices or the returns they should reflect the growth in company, right? Because these are the uh, fundamental kind of aspect of the company, right? Which should go into the firm's prices. But what we see is the growth in the stock prices have definitely outpaced the growth in the company's dividends or earnings. Right? So that there are this kind of mismatch. But how do these things happen? So this kind of mismatch happen because there are many surprises in the sense of many stock prices turn out to be unexpected by investors. Right? Now, in that case, there's a problem like in the future, those unexpected surprises might not happen again. Yeah? Because if you use the past to forecast future, you want to capture the most common trend or the most common kind of similarity between the past and the future. Right? For example, I mean, you know the company has been doing well in the past 5 years, right? But you don't want, so when you make a prediction about the future, you don't want these 5 year past returns are just coming from luck, right? That is not a good prediction because if the 5 year past return is just coming from luck, then if you make the prediction about the future, in most cases it will be inaccurate because we know that luck cannot be counted on, right? So I mean, if you want to forecast about the future, you need to know about the fundamental, right? For example, the company's recent 5 years good performance, it is because, for example, company has a new technology. The company has entered into a new market, which gives it a super good growth opportunity, right? That's why if you look into the future, now you have the belief that in the future it's going to perform better. It's going to perform well as well, right? So that is the reliable forecast. But if it's almost all unexpected, then the forecast might not be that kind of reliable, right? So that's kind of the idea. So in that case, if we believe that maybe if we use the historical average, that might be overestimate the market risk premium. So we might want to adjust the the expected market risk premium down, right? Um, so in that case, the decrease in the expected market risk premium can actually lead to an increase in realized rates of return, right? So that is the idea. And we're gonna show this through this example. Suppose the market portfolio of common stocks, they pay aggregate dividend of 120, right? And then this portfolio yields 5% and dividend growth rate is 4%, right? Now, first of all, we can calculate the present value of the portfolio using the formula that we see in the valuation of the stock, right? So basically, we have this formula which is the present value of the stock, the present value of the portfolio equals the first period dividend divided by R minus G, right? R is the discount rate, G is the dividend growth rate, right? Now, in that case, so the first period dividend is 120, right? Now, if the portfolio yields 5%, dividend growth rate is 4%. In that case, the expected total return, right? Expected total return is 5 plus 4, which is 9%. Right? Now, so that is the total return, which is the R here, right? Now, this G dividend growth rate is 4%, right? Now, if we use this formula, it's going to be 120 divided by 9% minus 4%, which is 5%. So now you will get the present value of the portfolio is 2,400, right? That is the present value of the portfolio. And what is the risk premium here, right? Now, first of all, the total return is 9%, right? The yield plus the dividend growth rate. But that 9% includes already a risk premium, right? Suppose the risk-free rate is 2%. Now the risk premium is going to be the overall total return, which includes the risk premium already, minus the risk-free rate 2%. Right? So in that case, you get risk premium equaling 7%. Right? Now let's do the adjustment. So suppose investors require only 6%. So their required return goes from 9% to 6%. Right? And then the required return in that case becomes 8%. So that is the required return, 6%. Right? Now the risk-free rate is 2%. So in that case, the required return will be 8%. Now using the same formula, we can get a new present value of the portfolio, which is 3,000. Right? Now, in that case, you can see we have adjusted our expected risk premium down, right? From we adjust the risk premium from 7% to 6%, right? And the total return goes from 9% to 8%, right? So now you can see there's a decrease in the expected risk premium, right? Now this causes market value to increase by a lot, right? By 25%, right? That is 2,400 go to 3,000, right? Now in that case, the total return increase as well, increased by 30%, right? So how do we get this 30%? It's gonna be the 20%, right? 25%, that is the market value increase, right? Plus the 5%. So in that case, it's 30%. So 5% is the dividend growth rate, right? 5% is the new, because we have adjusted our expectation, right? So in that case, the 5% is the initial yield, so that's 5%, right? And then 5% plus the 25%, then you get 30%. That's the total return increased by 30%. So now the exposed or the realized risk premium is 28%. That is much higher than expected. So again, we need to differentiate between expected risk premium and the realized risk premium, which is now 28%. So how do we get this 28%? That is the 30% minus the 2% risk premium. Again, let me go through this calculation, right? So we start from aggregate dividend of 120, right? The portfolio yields 5%. The dividend growth rate is 4%. Now the present value of the portfolio is 2,400 using this formula here. Now again, here the key thing is that the total return is 9%, right? Which is 5 plus 4. Now the risk premium is 9% minus the risk-free rate, that is 2%. So you get a risk premium of 7%. Now suppose we adjust the risk premium, adjust investors' expected risk premium down, right, from 7% to 6%. Correspondingly, the required return goes from 9%, right, to 8%. Now the present value of the portfolio is 3,000, right? Now in that case, a decrease in the expected risk premium causes market value to increase by 25%, right? Which is 2,400 to 3,000, and the total return increased by 30%. So this 5%, I mean, the difference is this 5%, which is the dividend yield that the investors now have for the future. So then in that case, the risk premium is 28%, which is the total return minus risk-free rate, 2%. Risk premium is 28%, much higher than expected, right? Because the idea, again, is what we said here, right? A decrease in the expected market risk premium lead to the increase in the realized risk return, right? And then if you have an increase in the realized risk return, then there's an increase in the realized risk premium as well. And so this graph shows the dividend yield and the risk premium over 1900 to 2014, right? We see a very sharp decline in the dividend yields, right, from 1900 to 2014. Right? And this trend is very sharp. Now, we see that the dividend yields have been going down for all these years, right? Then what we see is that the ratio of the price to dividends actually increase, right? Because I mean, if you calculate price to dividend, dividend is the denominator, right? And in that case, the returns realized by investors also increase, right? So these are the two observations we have. So then our conclusion here is that part of the market returns and the risk premium we observe, right? Because there's a seemingly contradiction here, which is market return and risk premium is going up, but the dividend yields have been going down, right? Now, in that case, we can see that the part of the market returns and the risk premium could be attributed to not just to the growth in the dividends, but also to the higher price that investors are willing to pay for per dollar of dividends, right? So this is the idea. So that's why we need to adjust historical average risk premium downwards, right? By subtracting that part of past average returns that came from the upward trend in the price dividend ratio, right? So that is the reason why we need to adjust this historical average risk premium downwards, because it's too high. It reflects it. I mean, the reason why we do this is that we want to have a historical estimation, historical average, to better reflect the fundamental, right? But it seems that the fundamental is going down, right? Now we need to adjust this to better reflect the fundamental. Now, how do we adjust this? We need to adjust this historical risk premium downward by subtracting that part of past average returns that came from the upward trend in the price dividend ratio, right? So which is the fact that there is a higher return, higher risk premiums because investors are willing to pay higher price, right, for per dollar of dividends, right? It's not just that it's not that dividend has been going up, dividend has been going down actually, but it's just that investors' willingness to pay is going up, right? But this part you cannot easily extrapolate into the future, right? I mean, it could be that in the future maybe investors they are less willing to pay a higher price for per dollar of dividends anymore, right? I mean, it is always possible. But that's why we need to adjust adjust the risk premium to reflect the true fundamental trend of the stock prices. Now we move on to talk about how to measure portfolio risk, right? So basically, there are two. The standard statistical measure of the risk is variance and standard deviation, right? And variance is the expected value of the square difference between a return with the average, right? So this is variance, basically the definition of variance. And the standard deviation is the square root of the variance, right? Now this is the actual return, right? and this is the expected return. I mean, in real calculation, this expected return will be just the average, right? And this formula that could be calculated for both individual security and portfolios of security, right? So you can just pull up the historical data. For the historical data, calculate the average. The average is gonna be expected return, right? Then each observation, each data point is the actual return. Right? Now, if we calculate this risk, right, there must be a way for us to understand the distribution of the return, right? And in reality, we use normal distribution to represent the distribution of historical return. So, I mean, how can we do that, right? It's just that the property of historical stock return happen to follow the normal distribution, right? So what is that property? The property is that the median outcomes, they're more likely to happen, whereas the extreme outcome, they are less likely to happen, right? And then they are symmetric. Of course, in reality, there are many violations of this normal distribution, but normal distribution is the best approximation we can have for past the historical return, right? And it is very good approximation. And this is the graph that shows how does the normal distribution look like, right? Now you can see, so this is standard deviation, right? So this less than 68.26% of the observation fall into one standard deviation, right? That is minus one standard deviation plus one standard deviation. Now 95.44% observation fall into two standard deviation. 99.74, which is almost everything, falls below three standard deviation around the mean. Right? Mean is at the 0 point here. So the investment, I mean, if we use the normal distribution, there are many advantages, right? So for example, they're symmetric. So in that case, standard deviation is a good measure of risk, right? Because the positive deviation, negative deviation, they're symmetric, right? And also, the symmetric return also give you another advantage, which is if individual securities stock return follows normal distribution, portfolio returns follow normal distribution as well, right? And it is very easy to capture this distribution in the sense of you only need to calculate the mean and the standard deviation. Now you can already have this distribution, or you can draw this distribution already. And as long as you have the historical mean and the standard deviation, that is already enough to estimate future scenarios, right? Because you already have the distribution, and you know that in the future, the returns are going to follow normal distribution as well, right? So that's why it'll be easy to use those mean and standard deviation to estimate future scenarios. Also, we can just calculate the pairwise correlation, and they will summarize the dependence of return across security already, right? Because we assume that all individual security follow this normal distribution. The returns of individual security follow the normal distribution, right? In that case, if we want to capture the dependence of returns across security, we can use pairwise correlation, and it's very straightforward. It only depends on the two parameters, right? Mean and standard deviation. Right? And of course, in reality, there are departures from normal distribution. In our case, if the excess return are not normally distributed, excess return means that your total return minus the risk-free rate. So in that case, standard deviation is no longer a complete measure of risk because the positive deviation and the negative deviation, they are not symmetric, meaning that maybe positive deviation are more possible than negative deviation, right? That's one violation of normal distribution. That's why we have two alternative measures, which are skewness and kurtosis, right? So skewness is to capture cases where extreme positive events are more likely, right, than the normal distribution described. And it can also capture in extremely negative events are more likely than what the normal distribution captured. And the important difference of skewness and normal distribution is that if suppose you have a positive skewed distribution, that says extremely positive surprises, they are actually more likely, right? But it is asymmetric, meaning that extremely negative events, they are less likely than extremely good events, right? And same thing for the negative skewed, right? So negative skewness means that extremely bad news are more likely than extremely good news. Right? Now, kurtosis is a symmetric concept, which is they give more weight to extreme events, right? Including extremely good events, extremely bad events, right? So both extremely good and bad events, they are more likely than what the normal distribution describes. So in that case, they allocate more probability mass to the two kind of extreme end of the distribution. So these two are the parametric kind of estimation of, of returns that do not follow the normal distribution. We can also have two non-parametric estimation, right? One is called value at risk. So value at risk is basically capturing the loss corresponding to a very low percentile of the entire return distribution, right? That is the bottom fifth and first percentile. Another one is expected shortfall, right? Which is you can use a sample of historical returns, right? And then in that case, we can estimate the 1% expected shortfall by identifying the worst 1% of all the observations. So in other words, expected shortfall captures more, worse scenarios than value at risk, right? Because value at risk just looks at, for example, if you want to look at 1% VAR, that just look at the worst first percentile return, bottom first percentile return, right? But expected shortfall, they look at the worst 1%, right? Even including observation less than 1%, right? And take the average. So that captures the most bad news. And now we move on to the next concept, right? So when we go from individual security to form a portfolio, that is one security to like 5 stock, 10 stocks, right? So in that case, we want to use the concept of diversification, right? So the idea is that holding more stocks reduces our risk exposure, right? So this is the number of stocks, and this is the standard deviation. You can see if you have more stocks, the standard deviation goes down, right? So that is the power of diversification. And in this graph here, diversification can cut the variability of returns about in half, right? Basically, based on this diversification, we can calculate the portfolio risk. And then, we can see the idea of diversification actually much more clear if we calculate this portfolio risk. The simple reason why diversification can reduce risk is simply because stocks, if you have just one stock, right? The market goes down, then your stock goes down, right? But if you have portfolio, market goes down, then maybe in your portfolio, there are 2 stocks going down, but there are another 2 stocks going up, right? So which hedge against this downside risk, right? So that is stock that can move in opposite direction, they can hedge against each other, right? So let's look at this portfolio, right? Suppose you have 60% in Johnson & Johnson and the remainder is in Ford, right? So 60% Johnson & Johnson, 40% in Ford, right? So in that case, you expect that the expected return of Johnson & Johnson 8%. The expected return of Ford is higher, it's 18.8%. right? So now you can see Ford is more risky, right? Because it offers a higher return. Right? The expected portfolio return, therefore, it could be calculated as the weighted average of the expected return of these two stocks, right? Now, also we can calculate portfolio variance, right? So that is, this is for the formula for portfolio variance, right? X1 square, delta 1 square. So that is the delta is the so delta is the standard deviation, delta square is the variance, right? Now the important thing here is this rho 1, 2. Rho 1, 2 is the correlation coefficient, right? And basically, we can simplify this equation by calculating the covariance between two stocks, which is delta 1, 2, which is rho 1, 2 times delta 1 times delta 2, right? So this is the covariance between the two stocks. And the portfolio variance, which is the risk of the portfolio, right? Which is the thing that we want to prove earlier, that is diversification can reduce portfolio risk, right? The portfolio risk, which is the portfolio variance, is determined by this correlation coefficient, right? So if stocks move together, so that means two stocks that are positively correlated. In that case, the portfolio variance is higher, right? If two stocks are uncorrelated, which means there's zero, then portfolio variance is lower, right? This term is gone, right? Now, even better, if the two stocks move in opposite direction, now this rho 1, 2 is negative. In that case, portfolio variance is even reduced more, right? Because they hedge against each other. Right? That is the idea. Now, these are some numerical examples. So the conclusion here is that the greatest payoff to diversification, the greatest diversification benefit comes when the two stocks are negatively correlated. Right, because they hedge against each other. So in our case, it's when the correlation is equal to -1. And basically, as long as you have portfolios of less than perfectly correlated assets, the portfolio can always offer some degree of diversification benefit, right? That is the idea. In the extreme, like we just talked about, you can have perfect hedging assets, which is their returns moving exactly opposite direction, right? So in that case, if the correlation coefficient equals -1, we can solve the portfolio allocation. Portfolio allocation means that how much in Ford, how much in Johnson & Johnson. So we can solve the optimal portfolio allocation that give us the lowest risk, give us the lowest portfolio variance. No? Basically, we can set this formula to 0 where rho 1, 2 equals -1. Now that is the thing we get. So under these ways, the standard deviation of the portfolio actually goes to 0. Right? That's why it's a perfect hedging asset. Right? So the risk of one stock is perfectly reduced, eliminated by another stock. Right? Now, theoretically, like we just showed, diversification seems very, very powerful. Right? It seems that it can even reduce the risk to 0, right? Which is very, really powerful. But in reality, there are limits to diversification, right? Suppose that we have equal investment in N stocks, right? Then we can calculate portfolio variance in this way, right? So that is N times 1 to the power N squared times average variance between each of the two stocks, right? Now in that case, this could be broken down into two parts, right? Which is this one is N-1 times average variance, right? This part is 1 minus N-1 times average covariance, right? Because remember, we have N stocks, right? They each have variance, right? And then between them, they also have covariance, meaning that they can move in opposite direction, they can move in positive direction. We don't know, right? As long as they are correlated. So as N goes up, meaning that if you held more and more stocks, this part goes down, right? The portfolio variance steadily approaches the average covariance because this one steadily goes to 0, right? All we are left is this part, right? So in that case, portfolio variance approaches the average covariance, right? Now, in the extreme, if average covariance was 0, I mean, theoretically or ideally, then it would be possible to eliminate all risk, right? By just holding sufficient number of security. But in reality, it's almost impossible, right? Because it is almost impossible to not have positive covariance, right? So positive covariance, they're always there. That's why they set the limit to the benefits of diversification, right? I mean, another way to think about that is you're gonna as long as you hold many stocks, right? As long as you hold many stocks, there must be some stocks that move positively with the market, right? Because market risk is the systematic risk, right? As long as some of the stock they move with the market in the same direction, then it is impossible to have no positive covariance, right? Because they move in the same direction with the market. So therefore, in that case, it is impossible to have zero covariance, right? So in that case, the risk that can be eliminated by diversification is called specific risk or firm-specific risk, right? Now, if you cannot diversify away this kind of risk, there will be market risk, right? For example, macroeconomic factors, they are not diversifiable, right? You cannot diversify these risks away, right? And stocks, they have a tendency to move together, right? So that's why it is inevitable that investors are exposed to market uncertainty altogether. Right? Now, next, we're gonna look at some measures that help us to capture the portfolio risk. I mean, so like we just showed, right, the risk of a well-diversified portfolio depends on the market risk of the security. Now, from the portfolio perspective, how do we think about risk, right? The risk of individual security will be just like the contribution of individual security to the risk of a well-diversified portfolio, right? So now, remember that the way to think about risk here, it's actually different from the traditional way to think about risk, right? What is the traditional way? The traditional way is just calculate the standard deviation, right? But here, what is the risk? The risk is the contribution of individual security to the risk of a portfolio, right? So one individual security, it could be very high in terms of standard deviation of returns, right? But still, it could be less risky, right? For example, you can buy a pharmaceutical company. This pharmaceutical company is very risky in terms of you don't really know the future realization of its current innovation, right? Innovations can fail bigly, right? So that's why it is very risky in terms of if you look at the past and deviation of the historical return, right? But it could be that this particular stock moves against the market, right? So when there's a crisis, the stock actually does not go down as sharply as other stocks, right? In that case, it's not a very risky stock, right? Because it does not co-move with the market. So in that case, it's a good stock to hold, right? So that's why we want to measure how sensitive it is to the market, right? How sensitive a particular stock it is to the market, right? So if it's very sensitive to the market, it's risky, right? Because if the market goes down, then you are all screwed by the stock, right? If the market goes up, it goes up. So basically, we need some stocks that actually do not co-move a lot with the market, right? So that when a crisis comes, then you are better off, right? So now, how do we calculate this beta, right? We will talk about later, but here the concept is called beta. The idea is a beta, right? Stocks with a beta greater than 1 is more sensitive, right? So that's why the overall movement on the market will be amplified You can also have betas between 0 and 1, right? So they tend to move in the same direction, but not as much as those stocks with higher than 1 beta. Right? So here, this is what I've been talking about, which is different from the traditional way to think about risk, right? The standard deviation of the portfolio return, which is a traditional way of measure risk, depends on the number of security, right? If you have more security, risk goes down. But now, here, the power diversification here depends on the average beta of the security, right? I mean, in other words, if the average beta of the security is close to 0, meaning that on average the stocks are not sensitive to the stock, then the diversification is good, right? Because diversification almost kills all the movement with the market, right? So that is good because you have some stocks that do not co-move with the market, right? So, but traditionally, if we think about portfolio risk, right? As long as you have more risk, as long as you have more security, you can eliminate the portfolio risk. But there's a part you cannot actually reduce. You cannot actually eliminate, right? Which is the market risk, right? So you eliminate from specific risk, but you are left with market risk, right? But here, if we think about risk as the sensitivity, as the common with the market, the diversification depends on the average sensitivity of your stocks to the market, right? So this is the 3 example, right? So shows that how beta determine the portfolio risk. So the red one has average beta 1.5, the portfolio risk is 30%. Right? Now you can see the higher the beta is, the higher the portfolio risk is. So, but I mean, the two kind of perspectives, they are not mutually exclusive, right? It is definitely true that holding more stock can reduce the risk, right? Because the variance part is reduced, right? But on top of that, if you have number of security, right? But on top of that, if the average beta is higher than 1, right? So in that case, the portfolio is more risky, right? But on top of that, if you have many security, on top of that, if you have very low average beta, which is 0.5, right? In that case, the portfolio risk is actually lower. So that's why the risk of a well-diversified portfolio, right? That is, you already have a lots of sufficient number of security there, right? In that case, the risk of the well-diversified portfolio is proportional to the portfolio beta, right? Which is equal to the average beta of the security included in the portfolio, right? Now, how do we calculate beta? Beta is essentially calculated as the covariance between stock returns and the market returns divided by the variance of the returns on the market, right? So statistically, later we can use a regression approach to estimate this beta, right? And basically, this ratio of covariance to variance measures the stock's contribution to the portfolio risk, right? So again, this is the contribution to the portfolio of an individual security. Now let's go back to the portfolio again. You have 2 stocks, Johnson & Johnson and Ford, one with a lower return, the other with a higher return. And one is less risky, the other is more risky. Right? So let's represent these 2 stocks on a graph, right? So that we know so that we can illustrate the relation between expected return and standard deviation on a graph, right? By having these 2 stocks. So that is the graph that we're gonna talk about. So we can we can show on the graph the combination of Johnson & Johnson and Ford. So basically this graph shows the combination of return and risk of this portfolio, which gives 6% Johnson & Johnson and 40% Ford. And then these three curves corresponding to different correlations. For example, this one gives you correlation of about 30%. So let me check if this is 30%. Yes, so not like between 0 and 1, right? So this one give you correlation of negative 1. So which means Ford and Johnson Johnson, they are perfectly negatively correlated. And this gold dotted line give you perfect correlation of 100%. So which means Ford and Johnson Johnson, they are positively perfectly correlated. So basically this curved line or including this gold dotted line and also the red dotted one give you how expected return and standard deviation change as you hold different combinations of two stocks. So it give you different combination as you move along the curve, and one curve corresponding to one correlation. And this is -1, this is 1, and this is somewhere between -1 and 1. So again, if they're perfectly correlated, it's the gold dotted line. And we know that if they're perfectly correlated, there's no diversification benefits, right? Because they move in the same direction. And if they're perfectly negative correlated, they are perfect hedging assets. So we talked about this earlier. And in this case, we have we have maximum diversification because the movement of one stock is counteracted by the movement of the other stock. So they are perfectly negatively correlated. So any risk produced by one stock is eliminated by the other stock in the opposite direction. So now we can plot the combination, or we can plot the relationship between expected return and standard deviation on a graph, right? And then based on that, we can work out what is the efficient portfolio here. So in other words, what is the optimal portfolio here? So how should the optimal portfolio look like? Basically, you need to maximize expected return while reducing risk, right? So that's why efficient portfolios or optimal portfolios should give you highest expected return for any level of risk, all right? So this table give you some examples of the efficient portfolios chosen from 10 stocks. So basically, these are the 10 firms, right? And then this is like for each one, we give you expected return and standard deviation. And so here, the column ABC, this gives you 3 efficient portfolios. The first one is 0, 0. So that means so that basically give as always no weight to A and B, right? And the second one give you 13% weight and 11% weight, right? And this table also calculates the expected portfolio return of portfolio A, portfolio B, portfolio C, right? So A, B, C, there's 3 different portfolios, remember. So let me repeat this again. Portfolio A, portfolio B, portfolio C, there's 3 different portfolios. Portfolio A, so the numbers here are the weights of each stock in this portfolio, and B as well, right? Different weights. And portfolio C is special. It only holds Ford, right? 100% in Ford, but it is still efficient, right? So, and then for each one, this calculates the expected portfolio return for ABC and also portfolio standard deviation. for portfolio ABC, right? And then on this graph, we have shown ABC on this graph, right? Because for portfolio A, B, C, we can respectively calculate return and standard deviation. So A, B, C, and there are many other efficient portfolios, right? As long as the portfolio maximize expected return for any level of risk, we can plot this one. I mean, this is quite intuitive, right? So, I mean, if you go from here to here, right? So for any level of risk, that is the highest expected return you can get, right? So for any level of risk, calculate the portfolio that give you the highest return, highest expected return. That is on the efficient portfolio frontier. And at any point, any diamond points of the red curve is not efficient. Right? So basically here, portfolio C, but if we compare ABC, let's compare all the efficient portfolios here. What is portfolio C? Portfolio C offers the highest expected return among all efficient portfolios. Right? So remember, for each level of risk, there is an efficient portfolio. Then among all efficient portfolios, we can work out what is the portfolio that give you highest expected return. So on the red curve, that is portfolio C, right? And also, what is the portfolio that give you minimum risk? Here, it's portfolio A, right? So again, this comparison is globally across all efficient portfolios. Now we have the efficient portfolio, the idea of efficient portfolio here, right? Now we still need to figure out in other words, the budget constraint, right? So why would budget constraint matter? Because the budget constraint tells you how much you should allocate to risky asset, how much you should allocate to risk-free rate. So, I mean, that depends on your risk preferences, of course, right? So if you are, I mean, in the previous example, the Johnson & Johnson example, we allocate 60% to Johnson & Johnson, 40% to Ford, right? Of course, you can have another combination, which is, for example, 70% Johnson & Johnson and 30% Ford. So that really depends on your risk preferences, but that gives you different budget constraint. So that give you different points on the budget constraint, right? So then this line gives us the budget constraint, which is the allocation between risk-free rate and the risky asset. Because Johnson & Johnson, Ford, they are all risky assets, right? But in general, right? If you are investor, you will allocate some to risk-free asset like Treasury bills. You allocate some to risky asset like Johnson & Johnson, Ford, right? So this line tells you this decision. And basically, this point S should be the optimal point. And this is the red curve here is the efficient portfolio that we saw earlier, right? So, and then this point S is derived when you take the tangent point of this line to the efficient portfolio curve. Now let's look at how do we, I mean, what does this budget constraint mean, right? So suppose that you can always lend or borrow as a risk-free rate of RF, right? And then the only decision here then is how much you allocate to risk-free rate, how much you allocate to risky asset, right? So if you invest some of your money in Treasury bills and place the remainder in common stock S, right? We can combine any combination of expected return and risk along the straight line between RF and S. Right? If you allocate a number between the risk-free asset and the point S. Right? So what is point S? Point S is the common stock portfolio. So this common stock portfolio essentially means that you allocate no money. You don't allocate anything. You don't allocate any money to the risk-free asset, Treasury bill. So and then so this is I mean this is called lending area because there's no borrowing here. I mean if you have $100, the maximum you can lend you can allocate to risk-free asset is 100, right? So this is the lending case. So essentially, I mean this is called lending because essentially if you allocate some to risk-free asset, you are lending, right? It's like you're buying treasury bill, right? You're buying treasury bill, you're buying treasury bond, for example, and then someone is borrowing from you, like government, right? So government is borrowing from you. Now, if we allow borrowing, which means you have $100, but you borrow more in the risk-free asset. So for example, you have $100, you borrow another 50, and then allocate all 150 to risk-free asset. In this case, we can allow for borrowing, right? And we can allow for borrowing because borrowing is just negative lending, right? So in that case, we can extend the range of this budget constraint, the possibility to the right of point S, right? By borrowing funds at the risk-free rate RF, right? And then investing them as well as your own money in portfolio S. Right? So if we go above this point, this is like we're borrowing money and investing in this common stock portfolio. Right? So what I said earlier is that you initially can do lending. You allocate between risk-free assets and common stock portfolio. Now you can allocate nothing to the risk-free asset and borrow more money to invest in this common stock portfolio. Of course, it will be more risky, right? That's for sure. So this example shows that if you borrow and then invest more in the common stock portfolio, you're more risky, right? So 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 suppose that this portfolio have expected return 15%, standard deviation 16%. The treasury bill gives you 5%. So suppose you invest half the money in S and then half in a risk-free asset at, which gives you return 5%. And you can calculate expected return, which is the weighted average of the return you get from portfolio S and the risk-free asset. That is 10%, standard deviation is 8%. Now you can borrow at the treasury bill rates and amount equal to the initial wealth, right? And then invest all the money, including original wealth, and then the money you borrow in portfolio S, right? So in that case, you can see that is 2 times expected return on S minus, right? This is minus because now you borrow. This is the money you have to pay back the borrowing, pay back the debt, right? Your wealth is also doubled, right? Because you use original wealth plus the borrowed money, right? So that give you expected return of 25%, so which is a higher return. That also gives you a higher risk, right? Because again, that increases your leverage in investing. So your overall portfolio becomes more risky. So basically, when you lend a portion of your money, you end up between RF and S, right? So this is when you not borrow, right? Meaning that you allocate some money between you allocate some money into risk-free asset. You allocate some money. You allocate the remainder, the rest of your money into the common stock portfolio. Of course, if you borrow, you extend possibility beyond S, right? Now, in this case, S is the efficient portfolio, right? S is the efficient portfolio because that is the one that give you, for any level of risk, that is the one give you the highest expected return. So given the budget constraint here, this point S is the point that maximizes your expected return for any level of risk, right? And this is the point where the budget constraint is tangent to this efficient portfolio. That's why S is the efficient portfolio. So, I mean, that's easy to prove, right? If it's this point, that's not feasible because it's not on this budget constraint, in other words, right? So if it's on this point, that is feasible, but that is not efficient because the efficient frontier is here. That's the only set of efficient portfolios, right? And of course, this point T, for example, is not efficient, right? Because it's not on the set of efficient portfolios, or we can call this curve efficient portfolio frontier. Right? Basically, the way we try to find efficient portfolio is that we start on the vertical axis at RF and then draw the steepest line that you can to the curved red line of efficient portfolios. Right? You find the tangent point as the efficient portfolio. So, and then on this tangent point, we can calculate what we call the Sharpe ratio. This Sharpe ratio captures the trade-off between higher return and higher risk. Right? So high return, high risk. So we need to balance between these two. Now you can see, if we want to find out the efficient portfolio, that means for any level of standard deviation, we need to find a portfolio that gives us the highest risk premium. Right? So basically, we need to maximize Sharpe ratio. Right? So again, this is risk premium divided by standard deviation. So it's going to be the return minus the risk-free rate divided by standard deviation. Right? So basically, investors use this Sharpe ratio to measure the performance of investment manager. Right? As an investor, the job is, of course, to find the efficient portfolio, right? So in our example, it's point S, right? And we all, as a second point, this portfolio must be blended with borrowing and lending, right? So there is a combination of risk-free assets and a common stock risky portfolio, right? The particular combination, for example, whether it's 30% to risk-free rate or it's 60% to risk-free asset, this depends on a particular investor's risk preferences or depends on a particular investor's taste. Right? So then each investor should put money into just two benchmark investment, right? So a risky portfolio S and a risk-free loan. So now you can see, here's the thing, right? So first of all, the risk preferences determine the combination or the proportion of risky portfolio and the risk-free loan. So whether it's borrowing or lending, so risk-free asset, right? Now in this risky portfolio, you can divide between different stocks. For example, Johnson & Johnson versus Ford, right? So remember, the risk preferences, it only affects the combination between risky portfolio and the risky free asset, right? So this is determined by the risk preferences, right? Not the combination, not the proportion between Johnson & Johnson and Ford, right? Because we can already adjust that kind of weight, which is reflected in the combination of the proportion of risky portfolio S and the risk-free asset. That is the investor job. So now we finish the first part, which is risk return, and then we move on to the capital asset pricing model. Basically, the question that this model is trying to answer is that investors want to be compensated for risk, right? And what is the relevant risk we're talking about here, right? So the relevant risk here is the covariance with the market portfolio, right? Not the variance, right? This we already emphasized. That is, if you have more covariance, more positive covariance, that increases the difficulty of diversification. So it's harder to diversify away the risk. Basically, securities with high covariance, which is high risk, have to pay a high expected return because they're bad security, right? Because they pay when you need it least. In other words, when the market goes down, you need some stocks that move with the market in the opposite direction. These are the stocks that can protect you, right? And capital asset pricing model has this idea of the market portfolio. Basically, the capital asset pricing model tries to build a relationship between the individual securities excess return and the market risk premium. So market risk premium means market return and the risk-free rate. This market portfolio theoretically contains all risky assets. And the proportion of each security is the market value divided by the total market value. Ideally, even though it's not practical, is that the market portfolio reproduces the market as a whole. So in the CAPM model, we have some assumption. We need to have a perfect capital market, which means there's no market friction. And then for individual behavior, we need to assume that investors are rational mean variance optimizer. So mean variance optimizer means that they want to maximize the Sharpe ratio, right? As we just talked about. And then they have a common planning horizon, which is single period. And then they have common information, meaning identical input list. Right? They have homogeneous expectation, meaning that, for example, meaning that they have same expectation of the market return in the next period. Market structure is perfect capital market, meaning there's no tax, there's no transaction cost. The borrowing and the lending have the same rate, so you can borrow and lend the same rate, right? And then all assets are publicly traded on the public exchanges, right? Now, here's the key point of CAPM model, which is individual securities risk premium is a function of its contribution to the risk of the market portfolio, right? And also, the covariance of returns with the assets that make up the market portfolio. So what is the contribution to the risk of the market portfolio? Basically, the sensitivity, right? So how sensitive this stock is. And also the covariance of returns with the assets that make up the market portfolio. So why do we introduce CAPM model here? Because when we calculate the cost of capital, we need cost of equity. We also need cost of debt, right? But how do we get cost of equity? That is the required return of investors. And how do you estimate that? We usually rely on capital asset pricing model to estimate individual excess return. And that is the return we need for the cost of equity capital, right? So again, this point has been emphasized previously, right? The security might be quite risky if held in isolation, but if most of the risk can be diversified away, meaning that if most of the risk could be diversified away in a portfolio, then it does not matter, right? So all that matters is the contribution to the risk of the market portfolio. So this is the equilibrium condition in the capital asset pricing model. So basically the idea is that the expected return of, let's say, this stock called GE, General Electric, right, divided by the covariance of expected return of GE and market should be equal to the basically the expected market return and the variance of the market return, right? So in our case, the expected return on GE should be equal to the covariance of GE with the market divided by the variance of the market times the expected market return, right? And then this is essentially the beta we are talking about, right? How sensitive GE is. And this is called expected return beta relationship after we reorganize this term. So this is risk premium, right? So risk premium is the expected return minus risk-free rate, right? So this could be rewritten as expected return on GE equals risk-free rates plus beta. So beta is the sensitivity, right? Times the market risk premium, which is the market return minus the risk-free rate. So the idea is that the total expected return is the sum of the risk-free rate plus the risk premium. This risk-free rate is the compensation for waiting, right? So in other words, the time value of the money. This risk premium is the compensation for worry, right? So high risk, a high return, right? So if you want to incentivize investors to take a risk, you need to offer them commensurate returns, right? And basically, another interpretation is that the risk premium is the product of a benchmark risk premium, which is the market risk premium, right? And then the relative risk of a particular asset as measured by its beta, right? And what is beta? Beta is essentially the contribution to the overall risk portfolio. So again, the perspective here is that the risk premium does not depend on total volatility, but really it depends on the sensitivity of a particular stock to the market. And to extend this CAPM model, they can hold for overall portfolio, right? Because you can sum the relationship for each individual stock, right? And you still have the conclusion. And the overall portfolio beta should be equal to the weighted beta of the individual security, right? And here we usually think beta, if they're greater than 1, they are aggressive. If beta is below 1, they are defensive, right? In other words, beta greater than 1, that means stocks have higher risk, right? They can move with the market more. Now, after we have this expected return beta relationship, we can plot this one, plot the equation, which is called the security market line, right? The idea is that the securities risk premium is directly proportional to both the beta and the market risk premium, right? So this is the expected return beta relationship. And the slope here is the risk premium of the market portfolio. Remember, we are plotting expected return against the beta. Therefore, market risk premium is the slope, right? So expected risk premium of each investment is proportional to beta, right? And the proportion is market risk premium. So this is the security market line. The vertical axis is the expected return on investment. The horizontal axis is beta, right? This point is market portfolio where beta equals 1, right? And this is security market line, which give you the relationship between expected return and the beta, right? The slope is the market risk premium. This point is the Treasury bills, right? So when you have 0 beta, all you're left is the risk-free rate following this equation, right? Now this line or this equation basically give you a fair price, basically, right? Now you can basically price any stock by using the beta, right, which you can get from historical returns or from industry estimates, and then times the market risk premium. Now you can get a fair price, right, which gives you the required return of a particular stock. So that means if the assets return, they are exactly on the SML, the expected return are commensurate with the risk. But if you have a deviation, there are arbitrage opportunity. So meaning that the current price do not correctly correspond to the fair price or corresponding to the valuation given out by the CAPM model. If you have underpriced stock, they are above SML, right? Because their current return is higher than predicted by the CAPM model, right? So that means they're underpriced. If they're overpriced, they're below the SML, right? Because their current return is lower than prescribed than the CAPM model, meaning that their prices should drop so that the actual return will increase to the level described by the CMPA model, right? That is the idea. We can use CAPM model to do a lot of things. For example, capital budgeting, right? So this is the reason why we want to talk about CAPM model here, because we can use that required return as a discount rate. We can also find a mispriced security, right? So that is use the CAPM model as the benchmark and calculate the abnormal return, which is the alpha. Right? So if there is a deviation, if there is any positive alpha, that means the security is underpriced, right? So that means there are opportunity to buy underpriced stock and profit, right? And then also it can use as a performance measurement. For example, whether a portfolio outperforms the benchmark or did not beat the benchmark, we can use the benchmark as the CAPM model, right? Now here's the review of the CAPM model. So you can take a look. And what if finally, what if a stock did not lie on the security market line, right? So stock A and B. Now this we already talked about. The price of A have to fall, right, until the expected return matches the CAPM level, right? And then we say that this is overpriced, right? For stock B, this is also overpriced, right? But basically, you can get a high expected return. I mean, how do we improve it, right? We can get a high expected return for the same beta by borrowing 50 cents for every dollar of your money and investing in the market portfolio. Right? So this is basically arbitrage opportunity, right? So without taking more risk, you can achieve a higher return. That's why it's a risk-free arbitrage opportunity. So in that case, the market price of B will fall until the expected return of B is equal to the expected return on this strategy, right? So this borrowing 50 cents for each dollar of your own money and investing in the market portfolio. That will bring you here, right? That will bring you here. So bring you to the CAPM model. So this is an arbitrage opportunity that we can achieve if we find any stock's return deviates from the CAPM benchmark. Now, the alternative way to describe security return is arbitrage pricing model. This is developed by Stephen Ross in 1976, right? So again, this is the alternative benchmark. You can think about it this way. This is the alternative benchmark we can use to calculate the required return of a company. Basically, this theory predicts a security market line, again, linking expected return to the risk, right? And the proposition is that, first of all, security returns, they can be described by a factor model. So factor model means that there are multiple factors, right? Like, for example, inflation, that's one factor. You can also have, let's say, interest rate as another factor, right? So it's not just the market return. It could be different macroeconomic factor, different, even you can even include industry factor, right? So basically, the idea is that, and then so this is the first proposition, but another two proposition basically says that there's no arbitrage opportunity. Right? If we have this benchmark, if we have the factor model as the benchmark, then there's no arbitrage opportunity because there are sufficient security to diversify away idiosyncratic risk. There's no arbitrage opportunity for each individual stock. So what is arbitrage opportunity? So arbitrage basically means that there's a zero investment portfolio with a sure profit, right? Meaning that you don't have to take any risk, but you can earn positive excess return. The foundation for this no arbitrage condition is that if two assets are equivalent in all economically relevant aspects, or if they are economically or fundamentally the same, then they should have the same market price, right? And this is because they are arbitrages, right? So if there is a violation of this principle, of this condition, then they will engage in arbitrage opportunity. For example, if they find underpriced security, like we saw earlier, they will try to bid up the price, right? They buy the underpriced security, they bid up the price, so that ultimately there's no arbitrage opportunity anymore. Now, formally, we can write down the equation for arbitrage pricing theory. Basically, it's similar to CAPM, except that it assumes that each stock's return depends on pervasive macro influences or factors, right? So return equals A plus lots of factors, right? Plus this noise, right? This noise is like idiosyncratic risk that is very specific to a particular firm. Basically, this goes back to our diversification idea, right? So for any stock, there are two kinds of risk. One is systematic risk, the other is firm-specific risk. Right? So again, the expected risk premium could be explained by a factor of macroeconomic risk, different factors. Right? Another way to think about this is it's just one extension of the CAPM model. Rearranging this model, we have expected risk premium equals the linear combination or the combination of different risk premium, right? Different factor risk premium. So if the beta, they're all zero, expected risk premium is zero, right? Basically, what that means is that if you have a diversified portfolio, but this diversified portfolio has zero sensitivity to each factor, right? What that implies is that it should offer the risk-free rate, right? Because it has no risk. It is not sensitive to any kind of factor risk. And if the portfolio offers a higher return, investors could make a risk-free profit by borrowing to buy the portfolio, right? And if it offers a lower return than the model, definitely, right? So you could make arbitrage profit by running the strategy in reverse, right? So again, this is no arbitrage condition, right? If there's an arbitrage opportunity, then you can make riskless profit. So so let's see this equation, right? So and then let's look at one example. Imagine that you can construct two portfolios, A and B, right? And then they are affected only by factor one. There's only one factor. I mean, like a market, not market index, market return, right? Then if portfolio A is twice as sensitive as portfolio B, portfolio A must offer twice the risk of premium, right? So again, beta measures the risk, right? Now, if you divide equally between a Cherry bill and a portfolio A, the combined portfolio has the same sensitivity to factor one as portfolio B, right? So therefore, they should offer the same risk of premium, right? Because even if you allocate equally between Cherry bill and portfolio, the sensitivity to factor one does not change. I mean, you are still sensitive to factor one, right? So that's why this combined portfolio should offer the same risk of premium. Now suppose that a combination of T-bill and portfolio offer higher return, then there's arbitrage opportunity, right? Basically, investors, they can sell portfolio B, right? Because portfolio B and this combined portfolio, they have the same risk exposure, right? And now if portfolio A has a high return, then you can short portfolio B and long this combined portfolio of Cherry bill and portfolio A, right? That's the arbitrage condition. So just a little bit difference between APT and CAPM, right? I mean, the difference is that APT does not have a market portfolio, whereas CAPM model has a market portfolio. And the convenience of APT is that you don't have to worry about how to measure this market portfolio. And the arbitrage pricing theory does not tell us what the underlying factors are. I mean, so what the underlying factors are, it's an empirical question, meaning that you can let the data speak for you, right? So, for example, you can regress. I mean, you can include as many macroeconomic factors as you want, and to see what are the ones that affect individual returns more, right? Then you can figure out what are the underlying factors to be included in the APT theory. On the other hand, the CAPM model collapses all the risk into a single factor, the return on the market portfolio, right? So that is the difference. Now, above that, on top of that, we can also have another model. So this is Another alternative is three-factor model. This is the variation of this three-factor model is proposed by Fama and French. Eugene Fama and Kenneth French, right? So in this three-factor model, basically we first identify a reasonable list of macro factors and estimate the expected risk premium on each factor, and then measure the sensitivity of each stock to the factors, right? That is the general step when we try to estimate a factor model or APT model. A very famous version of the three-factor model is called the Fama-French three-factor. So what's important here is that it actually builds on CAPM model, right? It has three factors. One factor is the market return. The other factor is, one factor is called SMB. The other is called HML. Right? So what is SMB? SMB is basically called small minus big, right? So that is the return of a portfolio of small stocks in excess of the return on a portfolio of large stocks, right? Small stocks minus large stocks. And also high minus low. So high minus low meaning that is the return on a portfolio of stocks with a high book to market in excess of a portfolio of stocks with a low book to market, right? So it's high minus low. So basically the question, I mean, of course they have justified this, but the question is, of course, are these firm characteristics correlated with actual systematic risk factors, right? The answer is yes, right? What they find is that basically small firms perform better than the big firms. That's why there is an excess return for this SMB portfolio, meaning that you do have factor risk premium associated with this factor. You also have this factor risk premium, right? Which is for the HML portfolio. So basically, the market cap and the book to market ratio basically can predict deviations of average stock returns from levels consistent with the CAPM. Right? And I mean, you might think that they are not obvious candidates, right? So it's not obvious that the size of a firm can explain the return, but they might actually proxy for very hard to measure more fundamental variables, right? For example, firms with high book to market ratios are more likely to be in financial distress, right? And small stocks may be more sensitive to changes in business condition, right? So it's not that small firms itself can affect return. It's really the economic conditions that underlie small firms versus big firms, or underlie the high book to market firms and low book to market firms that explain the returns, right? So that's why these things can capture sensitivity to risk factors. And if we compare Fama-French and CAPM, the Fama-French model, they can explain over 90% of the diversified portfolio returns, but CAPM explains 70%, right? And based on these things, there are more and more efforts at looking at country-specific factors. Right? And also, there's a Fama-French four-factor model that was developed later, right? Basically, it includes another factor called momentum factor, right? That is the tendency for the stock price to continue rising if it's going up and to continue declining if it's going down in the recent past, right? So they find that this factor can explain the returns dramatically as well. Right? So you can take a look at the slides here. Now, the final part of this topic is that, so I mean, it basically closes the loop we're trying to draw here. Right? Why do we need the CAPM model, right? We need that to calculate cost of capital. To calculate the discount factor, we use to discount the value of the stock. We use to discount the cash flows where if we calculate NPV or project, right? Basically, in general, cost of capital is defined as the expected return on a portfolio of all the company's outstanding debt and equity security. right? So then the appropriate discount rate is the one we get from the expected return, right? So it is the discount rate also for the firm's average risk projects. Now, if the company has no debt at all, then cost of equity will be just equal to cost of capital, which is the expected rate of return on the firm's stock, right? So that is expected rate of return on the particular company stock, right? For example, cost of equity for Johnson & Johnson is the cost of capital for Johnson & Johnson, so right? If Johnson & Johnson has no debt. Suppose the risk-free yield is 2%, right? And then the market risk premium is 7%. And suppose beta is 0.53 is the beta, then we can calculate the expected return of Johnson & Johnson equals to 5.7%, right? And basically, the key thing here is that the cost of capital is the correct discount for cash flows only when we use it for projects that are on average consistent with the risk profile of the company, right? If they're more risky than the existing business, we cannot use that. If they're less risky, neither can we use that, right? Each project should in principle evaluate its own opportunity cost capital, right? Because the risk level might be different. Basically, we can look at the relationship between the required return and the project beta, right? Basically, this is the cost of capital, which is the required return by the investors, right? And then you can think about this is the return described by the CAPM model, right? And then this is the security market line, right? Which describes the relationship between required return and project beta. If it's more risky, required return is higher, right? This one is the company average. You can think about it this way, right? So that's why it's a company level cost of capital. But different projects, they have different risk level. The average beta or average risk level of the projects for Johnson & Johnson is 0.83. And basically, Johnson & Johnson, they should accept projects with rate of return above the security market line, right? Because the security market line tells you the required return, right? So if the project you are talking about, you are calculating is high risk, then you need a higher return. If it's lower, then you need a lower return. Right? Now, suppose we have debt, then the calculation is a little bit complicated. In our case, the cost of capital is then estimated as the mixture of the cost of debt, which is essentially interest rate, and the cost of equity, right? And the expected rate of return demand. So basically, what is cost equity? Well, I have been mentioning this for a couple of times, right? It is essentially the expected return demanded by the equity holder, which is the investors in the firm stocks, right? Suppose Johnson & Johnson's balance sheet is like this way, right? So that is 30%, equity is 70%, right? And the debt, this is the cost of debt, 7.5%. Equity is 15%, right? Now in our case, 7.5% cost of debt is the opportunity cost of capital for debt holder. 15% is for the equity holder, right? So that's why you can obviously, right? So obviously you can see cost of equity is higher than cost of debt because equity is more risky than debt, right? So what is debt? Debt is just like corporate bond, right? So that's why common stock is riskier than corporate bond. That's why investors of the common stock require higher return, right? Because higher risk, higher return. And again, it's because debt is safer than the assets. Basically, cost of equity is also greater than the cost of capital because equity is riskier than the assets. Right? And of course, equity is not a direct claim. It is the residual claim that stands behind debt. So later when we talk about capital expenditure, we will say that shareholder, right, the equity holder, they are the residual holders. They have the residual rights, right? but the creditors, the debt holder, they have the first right to the company when a company goes bankrupt. Cost of capital, if we look at this table, right, it's going to be the weighted average of the cost of debt and the cost of equity, right? So which is 7.5 times 70%. 70% is the weight on the debt, right? So 70 is the weight on the equity, right? So which gives you cost of capital equals 12.75%. And then this weighted measure is called cost of capital, or weighted or WACC, or weighted average cost of capital, or WACC, right? You can also include tax here, right? Why do we need tax? Because when you pay interest payments, right, that affects the tax payments, right? Tax payments are usually after tax payment. So after you pay interest, then you need to pay tax, right? So then how much earnings you have after interest payments is your taxable income, basically. So later when we talk about capital structure, we'll have this one. But here you can just think about, you can just keep that in mind for this point, for this moment, right? The after-tax WACC is going to be 1 minus the tax rate times the cost of debt, right? Times the debt ratio plus the cost of equity times the equity ratio. Right? In all cases, 12.5%. Here we assume the tax rate is 35%. Right? Now we have the cost of capital, but the question is how to measure the cost of equity, right? Again, we use CAPM model, right? So this we already said. So basically, we will use regression analysis, right? So I will talk about this technique next time, but keep that in mind for a second, right? So we can regress individual stock returns on market return to estimate this beta, right? And then we get this return from the regression analysis. So this is the regression analysis basically. And this R square, I mean, this is one of the regression outputs. Basically, this R square here, basically is how much variation in the individual stock return can be explained by market risk premium, right? So basically measures the explanatory power of the market risk, right? So this is in different companies, right? So Dow, Microsoft, right? And then if you look at this one and this one, right, they differ in the periods, right? So after financial crisis, Dow co-moved with the market more. Before the financial crisis, they co-moved with the market less, right? For Microsoft, it is similar, right? And then we also have the beta estimate, that is 2.34, beta estimate 1.65, right? In the parentheses, there are standard errors, right? Which is a measure of how good the CAPM model is, right? How do we do it statistically? I will explain next time, but just keep that in mind for a second. The slope is the estimate of beta, right? So I mean, you can think, so there's a difference here, right? So when we explain the theoretical idea, we say expected return beta relationship, right? When we estimate beta, we need to estimate the relation between individual risk premium and the market risk premium. The slope is the beta. And the R square here measures the proportion of the total variance that can be explained by market movements, right? So this is the idea. And we also, when we use the statistical model to estimate this beta, we also calculate the standard error of the estimate beta to show the extent of possible mismeasurement, right? For example, they also set up a confidence interval. Right? So this part I will talk about next time, right? So because it involves a couple of statistical concepts like what is the regression model. But basically, it tells you how good the model is. It tells you how confident you are about your model estimates. Right? So let's skip this for a little bit. So suppose that, we can estimate individual firms' beta. We can also use industry average, right? For different firms, we can calculate industry average. Here, let's suppose that we use the industry average 1.24. Right? So this is like we already get the beta estimate, right? Now the rest we need to do is just like plug in the CAPM model, right? Then they get the individual stock return. Now, another complication is about the risk-free rate, right? Remember, CAPM model, it's a short-term model in the sense of you should always use the current risk-free rate in a year, right? So to estimate CAPM model, right? Because risk-free rate, the market interest rate is always changing, right? You cannot use the historical risk-free rate. Yeah. So there are two kind of get-arounds calculation methods for the risk-free rate that you can have for the calculation. First is you can use a long-term risk-free in the CAPM formula. And then in that case, the market risk premium is the average difference between market returns and the returns on long-term treasuries. Right? But remember, that doesn't mean you need to use a historical risk-free rate. You are just using, let's say, the current risk-free rate, the current yield, for example, for Treasury 30-year bond, or Treasury bill, or Treasury 10-year bond, right? Something like that. That's the first way to go. The second way is that we can retain the usual definition of the market risk premium as the difference between market returns and the returns on short-term Treasury bills. Yeah? So that's why CAPM model is a short-term model. Now, for example, suppose that the average risk premium for holding long-term bonds is 1.5. Right? That is basically the the return you can get by holding long-term bonds minus the return you can get by holding short-term bonds or short-term Treasury bills. In that case, the expected long-term return from bills will be equal to the yield on long-term bonds minus the risk premium, right, which is 1.1%. Now, suppose you decide to use a market risk premium of 7%. Now, in that case, we then can calculate the cost equity, right? So suppose the risk-free was 1.1%. This is beta we just have, right? Industry beta times the market risk premium, right? So here it should be 7%, 1.1%, right? Cost, we can calculate the cost equity. And so after we get a cost equity, right? And we can also finally calculate the after-tax WACC, right? So suppose the cost of debt is 4.2%, right? Then we can get the after-tax cost of debt equals 2.7%, right? And suppose the debt to company ratio is 9.4%, we can calculate after-tax WACC. Now, in general, the beta we are talking about, it's the beta of the company's overall assets, right? Now, a company is a portfolio by itself, right? It's a portfolio of debt and equity. Now, in that case, we can have separate betas for debt and equity. So this point, we will come back to it later when we talk about valuation. But here, just let you know, right? So beta, you can have beta for different components in a portfolio. Just like you can have beta for different individual stocks and beta for overall market portfolio. Same thing here, right? You can have debt beta, you can have equity beta, right? Now, the asset beta is the total beta, like the beta for the company. And the company is a portfolio of debt and equity. Right? And then this asset beta, as we pointed out earlier, it's the estimate of the average risk of this company, right? For example, it's the Union Pacific's railroad businesses, right? It's overall beta. Now, when we look at the project risk, again, we need to look at whether the project is more risky or less risky than the average businesses, right? So suppose a coal mining company needs to assess the risk of investing in commercial real estate. In that case, we cannot use the asset beta for coal mining. We need to look for the asset beta for commercial real estate company, right? Because the risk is definitely different because they're in different businesses now. Now, when we use, this model, when we try to value the project, we try to value or calculate the project risk, we need to keep in mind the different reminders, right? First of all, we need to think about the determinants of asset beta, right? Often the characteristics of high and low beta assets can be observed when the beta itself cannot be, right? Because beta, again, it's a portfolio thing, right? And also we don't want to be fooled by diversifiable risk. So what is diversifiable risk? For example, it's like a firm specific risk, right? So for example, if a pharmaceutical company, what is the diversifiable risk? It is the risk of one drug. So it's the failure of one drug, right? That is idiosyncratic risk. It's not correlated with the market risk, right? So this is diversifiable risk. This is not the risk we're talking about here. Also, we need to avoid fudge factors. So fudge factors are like confusing factors here, right? So you don't want to be confused. And also, so determinants of asset beta, right? So this is also quite important thing that we need to keep in mind. So basically, the fudge factor, they are basically like they're sometimes added to the discount risk for projects in unstable parts of the world. So how can we do that, right? So so basically, we need to adjust our cash flow forecast to avoid this fudge factor. Right? For example, something that is very rare happens with very low probability, right? But we still need to adjust our cash forecast to account for that small possibility, right? Don't take that as 100%, right? That is the idea. Now, there are different factors that affect asset beta, right? So firms with high earnings or cash flow betas should have high asset beta, right? Because they are more sensitive to the market movements or business cycles, right? So cyclical firms, they're more high beta firms because they can move with the market more. Right? Less cyclical businesses, they are low beta firms like food or tobacco, right? In other words, these are the businesses that do not move with the business cycle, right? If the economy is bad, people still consume food and tobacco, right? But if there's a crisis like now we are having, right, the COVID-19, airlines are going to hit, right? So again, this moves with the market, with the macroeconomic factors. Now, the other thing that affects asset beta is the operating leverage, right? What is the operating leverage? That essentially is the fixed cost relative to the variable cost, right? So if you have a high operating leverage, that means you have a high fixed cost, right? So these are the firms like airline company, right? Because they have a big chunk of fixed cost, right? Because they need to lease or buy like airplanes, right? They also need to invest a lot in the maintenance, right? So these are all fixed costs. Now we can decompose a company's revenue into fixed cost, variable cost, and the assets. Right? So basically, those who receive the fixed cost, they are debt holders, right? And then who receive the net cash flows, they are holders of the common stock, right? Because debt holders, basically, they receive the fixed cost, right? Because usually to construct those infrastructure, those fixed investments, you need to borrow from the bank. Right? So that's why they are the debt holders in the project. So they also get a fixed payment, right? How much you lend, you get it as a payback, right? And equity holder, they basically get whatever is left, right? So basically, the revenue here should be equal to fixed cost plus the revenue cost plus the asset. Yeah, so the reason is that, so I mean, that is already a transformation. The original equation should be the present value of the asset equals revenue minus the fixed cost minus the variable cost, right? So that is the present value of the assets is revenue minus the cost, right? So which like a profit. You can think about the asset as like a net profit, right? Now we can calculate the beta of each component here, right? Beta of the revenue should be equal to beta of the fixed cost times the proportion, right? And plus beta of the variable costs times the ratio, right? Times the asset beta and then times the ratio, right? Now here the fixed cost beta equals to 0 because it's like a fixed investment. They don't change with the market, right? Because it's a fixed number. And the beta of the revenue and the variable cost, they should be similar, right? Because they move with the conditions of a company's businesses, right? So in that case, asset beta equals the revenue beta times this one, right? So then you can rearrange term, get asset beta equals the revenue beta times 1 plus the fixed cost to asset ratio. So basically, this is how we get asset beta here, right? So now you can see if you have a high operating leverage, that means this ratio is high, right? So that already tells you, right? Your asset beta is high. On the other hand, if your revenue beta is high, meaning that your revenue co-moves with market condition, co-moves business cycle a lot, right? Like airline company. In that case, you also have high beta, right? So basically, companies with high operating leverage actually do have high betas. Right? So basically, that would be an idea, right? So if you have a high ratio of fixed cost to assets, you will definitely have a high. So there are also other sources of risk, like a project, because if you have a long-term horizon, there are also other kind of risk, right? Solvency risk, currency risk, any kind of thing, right? And then in that case, the project will have high beta, even though it may not have high operating leverage or cyclicity, right? And again, divisible risk here do not affect asset beta, right? So just like the example I talked about, pharmaceutical company, they have beta, right? It's like a firm specific risk. So in that case, they are like 0 beta events. Now, finally, we're gonna talk about how do we allow for possible bad outcomes and how do we adjust the evaluation of the NPV, right? So for example, this is like the left tail, right? Very extremely unlikely bad events, right? Suppose project Z produced just one cash flow, like 1 million, right? And then the discount rate is 10%. We can calculate the present value. Now there are some small chance that the cash flow could be 0, right? Suppose the chance is 10%. Now in that case, we can recalculate the unbiased forecast of cash flow. It's like the expected cash flow, which is 0.9 million. Yeah? So this is how we adjust this cash flow estimate, right? So that's basically avoiding the fudge factor, right? So avoiding the very small chance, the way is to take into account the small chance of events. Finally, we can also calculate NPV by calculate the certainty equivalent, right? That is that a single risk adjusted rate is used to discount all future cash flow, right? But project risk might be changing over time, right? So then basically what we can do is that we can convert the expected cash flow to certainty equivalents and then discount them. So because when we value different projects, we are using a single risk adjusted rate, right? For example, Johnson & Johnson is taking another project that is more risky than the firm's average businesses, right? But we don't know how more risky, right? For example, the average cost of capital is 10%, right? Then we know that a project is more risky than the average businesses, but we don't know, right? Is it 15%? Is it 20%? It's hard to quantify, right? So then what we can do is that we can convert the expected cash flow to certainty equivalence first, right? For example, we are considering construction of office building that you plan to sell after 1 year, right? For 830, right? Suppose the risk-free rate is 7%, and then the risk-adjusted rate is 12%, right? So that gives you a present value already, right? Now what you can do is that you can calculate the certain cash flow, right? Which is PV times 1.707, right? So what that means is that you convert to a cash flow that happens with certainty, right? If you use a risk-adjusted discount factor, the cash flow you are discounting is uncertain, right? The alternative way to do is that you use a discount rate, which is a risk-free discount rate, to discount a cash flow that is the certainty equivalent of a risky cash flow. Right? That is the idea. So a certain cash flow of this number is exactly the same present value as the uncertain cash flow, right? So now this number is the certainty equivalent cash flow, right? So in that case, to compensate for both the delayed payoff and the certainty, and the uncertainty in the real estate prices, you need this one, right? This is the compensation for the delayed payoff and the uncertainty, right? Right. So then part of it is the haircut to compensate for the risk attached to the risk, the forecasted uncertainty in the risk of the project. So this is how we do it basically. We discount the risky cash flow at the risk-adjusted discount rate that is greater than IF, right? Now this risk-adjusted discount rate adjusts for both time and the risk, right? Now we can also do that. What we can do is that we can find the certainty equivalent cash flow and the discount at the risk-free interest rate, right? Because this is risk-free. The discount rate is also risk-free, right? Now, so this is the alternative way to calculate NPV, basically, right? Okay, this is so much for this week.